$134 trillion. That's the estimated value of all publicly listed companies across the globe. And as of today, the US accounts for about half of this, with a stock market worth $64 trillion. To put this in perspective, that's larger than the value of Europe, China, Hong Kong, Japan, India, and several other major economies' stock markets combined. Over the course of the last 15 years, the US's share of the global stock market has more than doubled, rising from 20% in 2010 to almost 50% now. But as we're going to take a look at in this video, we may be on the verge of seeing this trend flip in the complete opposite direction. In fact, it may have already started. Since the start of 2025, the S&P 500 index, the US stock market, has lagged behind other major global indices. Germany's DAX 40 is up 35%, Hong Kong's Hang Seng Index has climbed 21%, and the Euro Stoxx 600 is up 20%. Meanwhile, US equities have returned just 6%. That's a pretty wide gap. Capital has been flowing into international equities rather than US ones since the start of this year. And again, we think this trend is only going to accelerate from here, and there's going to be some big opportunities to take advantage of. Now, I want you to take everything that I'm going to say in this video with a grain of salt. So far in 2025 at bravosresearch.com, we've had a total of 50 winning trades versus 47 losing trades. So we're right really only about half of the time. Our returns in the market don't come from being right all the time. They come from making significantly more money on our winning trades than the amount of money that we lose when we're wrong. And you can see that from our average percentage gain versus loss. That's what trading is really all about. And if you want to learn how to do it properly, you can go to our website by clicking on the link down below, subscribe to our membership, and you'll learn our entire trading strategy and get access to all of our trades as we take them. The recent underperformance of US equities is quite unusual. When we zoom out from 2010, we see the S&P 500 has delivered a massive 481% return, far outpacing most of the major indices across the world. And there's very solid reasons backing up this outperformance. Over the past 15 years, US corporate earnings have significantly outperformed the rest of the world. US companies have quadrupled their earnings since 2010. In contrast, earnings from companies outside of the US have grown by less than 80% over the same time period. A key reason for this is innovation. The US has been home to many of the world's most disruptive companies. We can see this when we compare patent data from each country. Since 2000, the US has consistently led the world in high-value patents related to advanced digital technologies. Today, the US holds 49,000 of them. That's well ahead of every other major global economy. US companies are completely dominating the global technology race, and yes, they are set to continue doing so as most advances in artificial intelligence are happening in the United States. The US AI market size is expected to grow from $173 billion to $851 billion over the next 10 years. That's nearly a 20% annual growth. All of this has led to a historic gap in valuations between the US and the rest of the world. We can see that by looking at something called the forward price to earnings ratio, which measures how expensive companies are relative to their future earnings. Today, US stocks are trading at 22.6 times future earnings. In comparison, international stocks are priced at just 14 times future earnings. And this premium makes sense. Investors are simply willing to pay more for dominant and fast-growing companies like Microsoft, Nvidia, Meta, Apple, Amazon, which have consistently delivered higher returns. And so this has brought us to a point where the US's share of the global stock market has not been this elevated since 2001. And here, as you can see, this was followed by around a decade of underperformance. We think we could be in the midst of seeing the exact same thing happening once again. Now, here you might be thinking if the US stays a dominant force in technology, it really should be continuing to grow its market share. But it's not quite that simple. For example, the underperformance of the US stock market that occurred between 2003 and 2011 had nothing to do with technology. The US remained the technological capital of the world during this period of time. The underperformance of the US stock market was caused by something completely unrelated related, and that is the US dollar. As you can see from the US dollar index, from 2002 to 2010, the US dollar entered a prolonged downtrend. This dollar weakness structurally benefited the international stock market. You see, when the dollar weakens, returns on US assets decline in foreign currency terms. For example, a European investor that's earning a 10% yield on his US stocks could actually lose money if the dollar drops 15% against the euro. As this happens, capital tends to naturally flow away from US stocks and into international equities, where the currency depreciation is not eating into returns. And so this phenomenon boosts demand for non-US stocks and lifts their price and their valuations relative to US equities. If we look at how the international stock market performs during periods of dollar weakness, we can see they usually tend to outperform. We saw this in the 1980s and again in the 2000s. So if the downtrend in the US dollar continues, which as we've highlighted in recent videos is our base case, it's likely that we'll see international markets outperforming the US one. Now, to be clear, we're not calling for a large decline in the US stock market, nor are we saying that we won't be looking for trades on US stocks looking forward. In fact, we do expect that US stocks will offer many opportunities the rest of this year. However, with the dollar showing signs of weakness and global equity performance starting to catch up, we'll be much more on the lookout for opportunities in foreign markets too. If you want to follow our exact trading strategies step by step, you can go to bravosresearch.com to subscribe to our membership. Thanks for watching.